Hello and welcome to the Wharton FinTech podcast. I'm your host Tarang Gupta and our guest today is Pushkar Mukewar, co-founder and CEO of Trip Capital. In his 13-year career, Pushkar has worked across various geographies and has a deep understanding of the global financial services industry. Prior to starting Trip Capital, Pushkar was a venture capitalist at Saama Capital and was involved with several high-growth startups in India. He has also been a consultant with Oliver Wyman and started his career at Capital One, developing credit risk analytics for the subprime consumer loans business. Pushkar holds an MBA from the Wharton School and an MS degree from the Georgia Institute of Technology. Join us as we discuss the working capital gap that SMEs face, differences in how financial services operates across the globe, doing a startup in emerging markets, the value that an MBA added to Pushkar's startup ambitions, and much more. I would also like to give a shout out to the third annual Wharton FinTech Conference scheduled for March 30th and 31st. Tickets are now live, and you don't want to miss the opportunity to hear from and network with FinTech leaders. This year's guest lineup includes Craycroft, QED Investors, Ribbit, Visa, PayPal, Chime, Ripple, and more. Go to whartonfintechconference.com or check out our LinkedIn page to get tickets. Now on to today's episode. Pushkar, good morning.
Hi, Tarang. Good morning.
How are you and where are you calling in from?
I'm doing well. I'm currently in Mumbai.
Awesome. Are you enjoying the weather right now in Mumbai?
It's okay, actually. Bombay weather doesn't really change much throughout the year, so it's pretty much constant, I guess. So, yeah.
Cool. Let's dive right into the questions first. For our listeners who may not know, could you give an overview of your career and how you got involved in FinTech?
Sure. So I guess I'll start from just a sort of quick background about my family. I grew up in India. I actually studied engineering during college. Then went on to, do my master's for grad school. I came to the US. I went to the US. Finished my master's, and then in fact started my career in financial services. So my first job out of campus was with Capital One, and I was doing a fair amount of work on risk analytics. I think Capital One was one of the pioneers of really leveraging data to solve essentially credit, or fill credit gaps in the market. So really leveraging data to address gaps which existed in the market, specifically the subprime market in the US, right? And that's where I started my career, predominantly looking at credit card and consumer portfolios, and then went on to, management consulting, worked with a number of financial services clients as on various projects, across the board. So pretty familiar with the financial services industry in general, not just in the US, but also globally. So spent some time in Europe, in the Middle East. And then I went back to business school. In fact, I was at Wharton, graduated 2011. And I think a lot of these elements of my background kind of came together, as I kind of stepped into the FinTech world, right? My background in technology and finance, which was my training, plus the opportunities I saw specifically when it came to credit access in emerging markets like India, and post Wharton, I did spend a couple of years in venture capital, but then I think the idea was always to eventually, launch my own venture. And I think it was predominantly the experiences I had growing up where I saw certain problems which I believed strongly needed to be addressed, combined with the educational and the professional training I had, being being an engineer by training, but then spending a number of years in financial services, which sort of all came together as we launched this venture.
So as you mentioned, you spent several years in financial services, right? And you worked across geographies, be it US, Europe, or India. In your experience, what are some key differences in how the financial services industry operates in each of these geographies?
Yeah. So as you would expect, I think, when we look at financial services companies in the US, I would say that, just in terms of leveraging data to underwrite, for decisioning. They're at a far more advanced stage than some of the emerging economies. Now, of course, there's been a lot of change which has been happening across emerging economies, more so in the last 5 to 10 years, where there's a lot of data digitization. But I think, at least if I reflect on my experiences then, there was a world of difference between how a more mature US financial services companies would look at credit, would look at digitization, would look at newer technologies and adopting newer technologies to service customers better, to manage risk better, etc. That was definitely like one key difference. The second key difference, which at least I observed, was that in a mature market like the US, you had a lot more, kind of evolution in terms of different ways of being able to offer credit, right? So you had secured creditors, you had unsecured creditors. Within that, you had different kinds of companies or different capital providers operating within different segments of the market, also at different price points, right? But I think what at least I saw was that markets like India, Mexico, which are regulated, the regulator also restricts the kind of providers which can exist, who can provide capital. The regulator also restricts the typical pricing which financial services companies can pass on or charge their customers, but it's not a true free market of sorts. And I think one of the big things about credit is that oftentimes your pricing is a reflective of the risk which you're taking, right? So which by effectively restricting the price bands, you're also leaving a lot of the market unserved, right? Or underserved. And that was the second thing which I saw, right? So first was, of course, the use of technology and data. And second was just this free market and maturity in business models versus, to some extent, a regulated market with a number of restrictions.
So talking about credit, let's talk about Drip Capital. What's its origin and what services do you offer?
Sure. So I think we started Drip really with the mission of making credit accessible for small businesses globally. We specifically focused on cross-border trade because that was the area we found that was, that credit access was one of the biggest challenges for most SMBs in that space. I mean, globally, it's estimated that there's a $1.7 trillion trade finance gap which exists, right, in this space. So that was the problem we really sort of to solve. And the reason why most customers have challenges accessing credit is that most of them are dependent on their local banks or traditional financial institutions who would oftentimes ask for collateral. They would have a long drawn process. They would expect financials in a way that most SMBs may not have them organized. And as a result, many SMBs don't get access to any credit or don't get access to adequate credit. And hence, there's a pretty large underserved segment of the market. So that was the problem we really sought to solve. We offer two kinds of products. One is focused on small business sellers, and really it's sort of an invoice discounting product where the use case is that the seller gets an order from an overseas buyer. They manufacture the goods, ship them out, and then they are waiting 60 or 90 days to get paid. And through our platform, they can get paid on day one, and essentially use that working capital then to sell more, right? The second product we offer is sort of a flexible payment term for small business buyers, where let's say a small business buyer is sourcing from a supplier, right? They have to make an advance payment to the supplier. But again, through our platform, we can advance the payment to the supplier on behalf of the buyer. And the buyer instead gets like 60 or 90 days to pay us back, right? So we enable both sellers and buyers to get like favorable payment terms effectively in their transactions, right? So now, as you can imagine, these are small ticket, short duration transactions, and hence technology and data plays a huge role in being able to process thousands of such transactions and being able to underwrite and manage risk across these transactions. And that's where large banks don't serve this segment well, and we are able to essentially build a technology solution which can enable credit access for small businesses.
Let's dive deeper into DIP's business model. How do you earn revenue? Who are your biggest customer segments and geographies? And do you have any competitors?
So I would say let's start with the typical customer. Typical customer for us is a small business, which we would define as any company which is doing between, let's say, $100,000 of revenue at the lower end to up to 15 odd $million on an annual basis, right? And most of these are B2B customers. That's the focus we have. We do cover customers across various industries, whether it's agro commodities, ready-made garments, industrial good manufacturers, both traders and manufacturers. So there's a variety of industries and kind customers we cover, right? In terms of geographies, we do work with over 6,000 odd businesses as sellers or buyers spread across 80 plus countries. However, our major presence in terms of acquiring customers or acquiring sellers or buyers is in three key markets, which is India, Mexico, and the US, right? So there we do have a lot of our sales effort focus, but then the idea is that while we onboard companies in these markets, through these companies, we can tap into the broader network of sellers and buyers, right? And as a result, we do work with companies across the world. In terms of our revenue model, it typically is a commission or a fee we charge for every transaction. And so for a typical 60-day transaction, the customer would end up paying us something like 2%, So whatever is the transaction value, like typically up to 2% of that on a typical 60-day transaction is what we charge the customer. And our model is that we also sell these assets to institutional and non-institutional investors. So we are essentially a platform. We originate the asset, but then we distribute it to a variety of capital market providers, largely in the US, right? And I think the fourth question you had was around competition. So I would say that we have been a pioneer in the markets we've operated in so far. There are a few competitors, but in specific pockets. So, for example, in the US, Flexport, which is another startup, logistics startup, they also have a trade finance offering. So sometimes we do run into them. We in Latin America or Mexico, we have some specific local startups which are competing with us there. But I would say that that being said, I think we are definitely the market leader in this space, across the markets we operate in. Yeah.
Another interesting thing I want to get a take on is the fact that historically, small and medium businesses have been a tough segment for fintechs, right? What was your strategy about breaking into these or building those relationships with these businesses?
Yeah. So I personally think that being able to cater effectively to small and medium-sized businesses, I think you kind of need to pretty much have a end-to-end solution where technology is a key aspect of your product or of your solution, because that's what enables you to profitably serve this segment of the market, right? And that then applies to all aspects of your product, right? Whether it's acquisition, whether it's servicing, whether it's collection, whether it's underwriting, right? So you almost had to think about an end-to-end technology-enabled solution to be able to cost-effectively service this segment and basically be able to process these small-ticket transactions, right? So I would say that I think has been key. The second thing is also the nature of our product or our offering, right? So when you typically look at small businesses, one of the big challenges is your cost of acquisition tends to be high if you have a sales model which is requires in-person acquisition, etc. Right? So I think first is that we've managed the cost of acquisition very well by really leveraging partnerships. Partnerships is a huge driver of business for us. And we work with all kinds of ecosystem players, whether it's logistics companies who are kind of servicing this segment of the market, whether it's even banks who are servicing this to some extent, have the branch network but don't have this kind of an offering, or we're also looking at sort of e-commerce companies and so on and so forth, right? Like, so getting or having using aggregators is a key aspect of our acquisition strategy. And the second thing is also the nature of our product. See, our product is almost like a credit line for the customer. So once they get onboarded, it's not like it's a one-time use kind of a product. They continuously use us. So we've seen customers who've been with us now for 4 or 5 years also, and on a consistent basis, whether it's every month, every quarter, they would have some transaction which they would still process through our platform. So what happens because of that is that we are able to, as long as we manage risk well, we are able to generate a pretty high lifetime value for the customer, and that's where the unit economics really start to work, because your long-term value or lifetime value then tends to be significantly more than your cost of acquisition, and then just having that technology be a key enabler across all aspects of the customer life cycle is very critical to then manage things.
Switching gears, I want to talk more about Drip's growth, right? So you were backed by several known investors, including Axel, Sequoia, and Y Combinator. How do you go about selecting an investor, and do you feel that at different stages of a company, what you see from the investor changes?
So I guess in terms of talking through, how we went about selecting the investors and that aspect of our journey. So at some level, I think part of it is also that at different stages, you just have a different set of investors you would typically be interested or be looking at investing in the startups, right? So at a very early stage, seed stage, Y Combinator was one of the best things which happened to us. I think at such an early stage, when you're still trying to find your product market fit, just being part of the incubation program at YC, learning from a number of founders, like being part of a community, just learning some very basic things which kind of sound obvious, but actually implementing them in practice is something you need to constantly be pushed to. Things like launch fast and fail, or really focus on your users and nothing else matters. So these things which YC always talks about, you actually sort of live them in practice, when you go through the batch or when you go through the program. So that was phenomenal. I would say once we graduated, we had some product market fit. We already started seeing some customer traction. It was then about raising capital to help start driving us to scale up. And fortunately, we were Axel and Sequoia have been great partners. Bing as well is another VC firm out of the Valley, and all three of them have been amazing partners, helping us on various aspects. Right. I think in terms of selecting these partners, a key element for us was just our chemistry with the specific partner who is going to be involved with the company. At the end of the day, while these are large funds, the ultimately how you engage with them really comes down to the specific partner who is engaged with us, right? So that was a key aspect. And just given their breadth and depth of experience within fintech and within the markets we operate in was another big plus, because a lot of things they have seen and they could help us avoid some mistakes which are pretty critical to manage as you scale the company. And that then continues to evolve. See, today, actually now at the stage we are at, we are looking for, or we continue to get involved with more strategic partners, right? So as part of our last round, we had certain investors who are either large family offices in specific markets who could open up doors there. They could also be folks who could connect us with a lot of debt capital providers, because ultimately a key element of scaling up this business is also the supply of capital as a platform, right? So if you could open up doors to insurance companies or more banks, those are the kinds of partners who are super valuable at this stage of the company. So it evolves as you kind of progress along your journey. And I think it's been a great experience working with all these investors.
What's next for Drip? Where do you see the company in the next 5 years? And do you see yourself expanding geographies or product offerings?
So I would say both. Our mission has evolved from being a trade finance platform to now moving towards trade facilitation. And I think just having worked with a lot of the small businesses across multiple geographies, we realize that it's customers, while finance or access to capital is a critical problem for them to really scale up their business, it just goes beyond that, right? They need, many of these SMBs need solutions around handling their foreign exchange, hedging their foreign exchange, sometimes finding insurance providers or being able to insure their business or their shipments, finding new buyers or suppliers, right? So I think we realize that we can have a much bigger role to play in this ecosystem and expand beyond providing credit access to a lot of these other problems which the small businesses have. Geographical expansion is just natural, given that we work with sellers and buyers and we are in the cross-border trade. We will continue to get more and more customers across the world. Latin America is very interesting as a geography, highly underserved, fairly large amount of SMB trade. South Asia is also very interesting. With the base in India, we have opportunities to expand within this region. So I would say that over the next 5 years, I would look at Drip Capital as a much more geographically diversified company with multiple products, but within the cross-border trade ecosystem.
And for the growth, you need the right people. So is Drip hiring? If yes, what do you look for in potential colleagues?
We are always hiring. I think, of course, just given the macro environment right now, we have paused hiring for the interim. But again, I think some of this is temporary. I think, I'm sure all of you are also following the global macro changes which are happening. But that being said, I think I'm really glad to have kind of brought on board some really really strong leaders along the way, right? And I think as you said, at some level, you can only accomplish bigger and larger things if you are able to build the right leadership team and then really align them towards a mission. So in terms of what we look for, I would say that cultural fit is very critical for us. At the end of the day, we realize that everything ultimately becomes about being able to work with each other, about being humble, about being being a true team player. And these are strong cultural elements which you would probably see amongst most leaders, and in fact, even 2 levels down at Drip, right? And across offices. The second thing is really kind of strong problem-solving skills, right? I think when you're solving the problem which hasn't been solved before in the way it's being solved now, you need very strong first principle thinkers. You need folks who can look at data, who can analyze data, who can really think about problems in a very first principles way. I think that's very critical. Now, that being said, in certain functions, you also need that domain expertise, because there are certain things where you don't want to reinvent the wheel. Something which already has been done and done well, you want to sort of, take the right kind of domain expertise or bring on folks who with the right kind of domain expertise. However, that being said, problem solving is still a very important skill which we look for, right? And third is folks who are driven by the mission, who want to scale up, right? And really tenure or experience matters less. I think there are folks I've seen through the 5-6 years I've been running the company who naturally scale up, and in a startup, I think oftentimes like a 25-year kind of journey can get compressed in 5 years, right? So it's really up to the individual to see how they can scale up. So we look for that kind of potential. Now, of course, you don't always get it right, but we've seen many folks who've been with us right from the beginning take on bigger and bigger roles, started as an individual contributor, now managing teams of like 80, 100 people, So, and that's like always nice to see. And those are the best. Those are the kinds of folks who can really help build a company.
I would love to get your take on the global, or as you touched upon, the macroeconomic environment right now. Right? What are certain segments within fintech that you think will really drive its growth in the next 5 years? And what are certain segments that you're bearish on?
Yeah, a good question. So I think we are still seeing, generally speaking, still very early days, of the fintech revolution. I mean, if you look at globally, financial services as an industry is really massive, right? And you're just starting to see innovation happening in various pockets within that industry just now, right? And many of these companies, while they're scaling up, there's a long way to go. So in general, I'm very bullish on fintech as an industry. Now, given the recessionary environment right now, I would be bearish on companies which don't have a very strong unit economic model, or a business model which is largely driven based on, hey, we'll acquire like 1 million users first, burn a lot of money, and then figure out how we monetize it, or then figure out how we make unit economics work. Those companies are unlikely to survive this downturn, given the fact that equity is going to be hard to come by. Every company is trying to control burn, and it's going to be a funding winter for the next 12-18 months, right? So unless you have proven out profitable unit economic model, you're going to have a hard time in the next 2 years for sure.
And for the last segment, what I like to do is have rapid fire questions with you to introduce you more as a person, as an individual to our listeners. My first question for you is, what is a fun fact about you that most people don't know?
Fun fact about me: I love traveling, and I'm a big foodie. I was about to hit sort of 40 countries before I turned 40, but unfortunately COVID happened. but yeah, I love traveling, and I'm a big foodie. So yeah.
My next one is sort of a hot question. You started your startup or venture post your MBA, and there are questions about what is the value of an MBA for people who want to launch their own ventures. What is your take on this? Do you think that doing an MBA helped you excel as an entrepreneur? And what advice would you give to people who are considering between starting a venture or going to business school?
Personally, I think it was super helpful, because I met my co-founder there. Firstly, secondly, I met a lot of my early investors who backed the company in the early days were through my network, which I built through the business school. Thirdly, I do think it adds a level of credibility when you've had the opportunity to go through a sort of a top MBA program, and I think I also do think that a lot of the MBA training, you just at some level understand basics of finance, basics of a bunch of other areas which you encounter as part of running the business, whether it's people management, operations management, finance, so on and so forth, which as a techie or as a technical person, you're not that familiar with. And rather than, I think it is that crash course of a 2-year MBA does help when you think about these issues, or when you do encounter these kinds of challenges in your venture, right? So my advice to folks would be that I think it is super helpful. At least personally, I think so. And yeah, I think in terms of so tied to that, in terms of the advice on whether folks who are thinking of starting up versus going to an MBA, I would say the advice I would give is that go to an MBA, but then start while you're pursuing your MBA. I think that's the best combination at some level, because 2-year MBA, you have your safety net, meaning that you're out of the workforce anyway. But actually launching a venture becomes really a practical implementation of what you learn in the class to running your venture. And you can also tailor your classwork in a way that you take classes, you specifically take courses which are geared towards helping your venture. And I've had some friends who started during business school, and I think if I was to go back, and one thing I would look to change is, if I had, if I mean, no, I would definitely would have loved to launch while at business.
What is the one thing you miss most about Wharton?
I think it's just all the friends and the social connections you build, right? I think that's what you eventually kind of remember. Of course, the coursework is there and projects are there, but I think the fondest memories are all the crazy parties you had, and all the crazy trips you went on. So it's really the people and being able to hang out with them as much as you do at business school. So,
if you could go back in time, what advice would you give to your younger self, or is there anything or a decision that you would change?
So yeah, I think one was the question you asked earlier, which is I would have loved to start earlier. Perhaps the right time was starting during business school rather than going down. Like, if my eventual goal was to start, I probably went with the crowd of recruiting while at business school, getting into a private equity, venture capital kind of a job, spending 2-3 years and realizing this was not for me before then taking the plunge to start, right? So that would be one decision I would definitely change. Yeah, other than that, I feel no regrets.
What role have mentors played in your career, and how did you go about building these relationships with these mentors?
So mentors have absolutely played a key role. I don't think I did anything specifically to build these mentorship network or find mentors. A lot of it happened naturally. I think you through your work experiences, through your educational experiences, you come across people who really inspire you. And one thing leads to another, right? I think so. At some level, I feel like, of course, you can be more kind of thoughtful about it. But personally, for me, it was not super thoughtful. It was just people I encountered along the way who really inspired me and led me to where I am, I guess.
Amazing. On that note, Pushkar, we'll let you go. But thank you so much for being with us today.
Thank you, Tarang. It was a pleasure joining this conversation.
Thank you for listening to today's episode of the Wharton FinTech podcast. If you like the show, then please show us some love on social media or consider leaving a review. It means a lot to us and helps spread the word to more listeners. If you want more content from our FinTech community, please subscribe to our podcast and find us on LinkedIn, Instagram, Twitter, and Medium at Wharton FinTech. There you will find interviews, articles, videos, and much more analyzing all aspects of the industry. As always, special thanks to our editor, Rafael Osteria. Signing off until next time, I'm your host, Tarang Gupta.